Hi everybody, I am Organized Chaos. My main name is not Organized Chaos, it's Shovik, and wishing you all a very happy new year, very happy 2012. And unfortunately, uh, we're going to start off with a very dismal topic, sovereign default, in this second info session. Secondly, it's a very informal setting. I'm really sorry for this, I apologize for that. Uh, if you don't like it, you can just probably not watch the video at all. I hope that's not the case. And good thing is my cam's working, so we'll start. The three things I'd like to talk about. First is what is default and the effects. Secondly, why is Greece default so much of a problem for the world? And finish off with the basics of the bond market. Okay, so I'll start with default. What is sovereign default? When a country cannot pay its debt, that's when a country defaults. So the most likely indicator of sovereign default is your debt to GDP ratio. Debt to GDP ratio for Greece right now is 200%. That's debt is 2 times that of the GDP. Debt to GDP ratio of Portugal is more than 100%, for Italy is more than 100%, which means more debt compared to GDP. For Germany's and all, you have it at 80%, India is at 65%, like that. Now, what are the effects of a sovereign default? First is capital flight. Second is currency devaluation. Third is your lockout, and there are other internal economic disasters like inflation goes up, unemployment rises, and things like that. There's a run on banks. What is capital flight? We'll just briefly talk about all of this. What is capital flight? Capital flight is capital outflows. So for people who had invested in your country, your land, your infrastructure, your roads and airports and buildings and hospitals and all that sorts, they're going to pull money out of there because your economy is not sustainable. They are not going to get return on their money, so they're going to pull money out. So that's a disaster. Secondly, you'll have currency devaluation, which means the currency that your country trades in, right? So if it's India, it's rupee, it's the US, it's the USD, like that. That will be worthless to the rest of the world because your economy is worthless, right? Second important point is lockout. So what is lockout? Lockout is it's the next worst phase of capital flight, capital outflow, or exodus, if you can say. Lockout is when the international credit markets do not lend to you anymore. Why? Because you've defaulted. So it gets worse from then on. So it becomes very difficult for you to finance your growth story from there on, right? So you want to get more money and put it into building new services, more goods production, factories and plants and machinery. You don't have money. People are not lending money to you because you've already defaulted. They're going to lend money to you at something called as penal rates. Penal because it's a penalty if you defaulted. So now you have penal rates. So they're going to lend money to you on penal rates. Penal rates is very high rates. So that's very much of a problem. Now, why is this Greek's default considered to be so much of a problem? There are two main reasons for it. Not exactly two main reasons, let's talk about it. Greece is not the first time a country has defaulted, right? Argentina defaulted in 1997, an $83 billion default. A similar level of default for Russia in 2001. But why Greece's default is causing so much of a problem is because, one, Argentina's default of $83 billion was huge, right? Greece's default, the IMF, International Monetary Fund, predicts the Greece default to be at $300 billion, right? So that's 4 times as bad as the Argentine default, right? 3 times as bad as probably the Russian default. I'm not very sure of the Russian default amount, but then it's equal to Argentine default. So Greece default is 4 times worse off than that default. So you can imagine the impact. It's going to be huge. Secondly, if you look at one of the effects that I stated, capital flight, currency devaluation. When Argentina defaulted, their currency was the peso. Peso devaluated by close to 70%, right? Now, if the Greek currency defaults, the Greece economy defaults eventually, right? They're still holding on. Then it's going to have its effect on the euro, right? And the problem is that euro is the second most held currency in the world. The first is the US dollar, second is the euro. So if the euro goes into the dumps, you can imagine what will happen to the rest of the world, right? So it's going to affect all those people who hold euro, and euro is being pretty widely held, right? It's been held more by the central banks as reserves. Also, it's been held by the European central banks. That's a problem area. So the currency in question, which is going to devalue because of the Greek default, is the euro, right? We're not just talking of some Bangladesh taka or the Argentine peso or something like that. It's the second most held currency in the world, the euro. So a crash in the euro is going to be very bad, right? So right now it's not that bad. Germany, France are doing a pretty good job. So if you look at the exchange rates, it has not devalued at all in that sense. It just dropped to some, I think, close to, I think it dropped to 1.06 USD. That was the worst drop as far as I know. That was 2 days ago. So that's how it works. So the amount of the impact will not only be on the euro first, secondly, the effect of that default that you have. It's a $3 billion default. It's not like Argentine default is nothing compared to this, right? Even the Argentine plus the Russian default is nothing compared to the Greek default. The trouble also exists is that Greek default is not exactly a one-off scenario. You're talking of the European Union. Today Greece defaults, tomorrow Italy is going to default, then Portugal is going to default, then you have some other countries which are already tottering on that line. So you have a chain of countries which are going to default. Why? Because they're all connected by the euro. So if the euro dumps, the others are going to dump again, right? That's how it works. So when you look at the impact that the euro has, it's huge. It's going to drag down the European Union. That's why people have been talking about bailing them out. So let's say, in fact, Greece got $95 billion of bailout. I don't know what they did with that bailout, but they completely misled that money into some wrong channels. There's another aspect to it, to the Greece. It's very interesting. It says Greece is going to default, right? They're going to default. They don't have enough money to pay for your debts. What can the Greek government do now to prevent a further worse scenario, right? I mean, if you just go through the financial analysis, you won't figure this out because this is more on the political side. Just want to talk about it because this is important. When you default, it does not mean that you completely default. You cannot pay 1 cent of your debt. No, you can pay some of your debt, and you cannot pay the majority of your debt. That's how it works. So you're going to default, but when you look at the data, who holds the Greek debts mostly. I have data from The Economist which says Germany holds 14% of the debt, US holds 5%, Britain holds 4%, Switzerland holds 21% of the debt, rest of the world holds 11%, and I think this is France, which I'm not very sure of the country, but there's a country which holds 25% of the debt. So 70% of the debt, of the Greek debt, is being held outside of Greece. 30% is being held within Greece. Who do you decide to pay with whatever money you've got? The outsiders or the insiders? My point is, you pay the insiders. Because, one, inside Greece, who is holding the Greek debt? The banks, right? The banks are crashing, by the way. In order to prevent a mass massacre of the financial system which is already in the dumps. What you can do now is repay your banks. Okay, the Greek government should look to repay Greek banks and not French banks or the German banks and all that. One, because if you pay your banks out, right, then it will in some way resurrect your financial uh, structure. Secondly, there's a political aspect to it. Your country defaults, the next time your government is not going to be taken, right? The people are not going to take that government again. They're going to revolt and all sorts of chaos is going to start. If you pay your banks, if you pay your local bondholders, your debt holders, right, you're going to at least appease them so that the government doesn't topple next time, because people are pissed off that you didn't pay them and you went out and paid the French and the Germans, and the government is going to stay. And if the government stays, then there's a better chance of policy and reforms to come into the picture, rather than if the government tumbles and there's a political crisis there and all sorts of nonsense starts unfolding and leads the entire Greek region into complete disarray. So that's another aspect. Who do you decide to pay? I suggest you decide to pay your insiders first, and then whatever money you have, you try and settle your debts to the French and the Germans and the Swiss and all that. Most importantly, I had to talk about bond markets. Now, you'll hear a lot about bonds. Okay, when you talk about sovereign debt, sovereign default, you'll hear a lot about what are bonds and all that. Bonds are nothing but a way to raise capital. There are two ways. One is you raise shares. It's also called as equity. And the second is known as bonds. Equity and bonds are two ways of raising capital, money. They're very different. Why? Because bonds are fixed income securities, equities are not. So with bonds, you know exactly what amount you're going to get if you hold that thing to maturity. Maturity is the duration of the bond. Equities give you a particular ownership in the firm. Bonds do not. Right? Bonds and equities are both traded on the markets. Bond is a debt instrument. Equity is a equity instrument, and things like that. There's something called, you'll hear a lot of terms on the basis of this. I want to just briefly go through them. Bond prices. Bond prices are the prices with which the bonds are traded on the market, just like share prices you have. Bond yield. Now this is very interesting. Suppose you have a 1,000 rupee bond, 10% of interest, and the time to maturity, say, is 1 year, which means the bond is valid, you're going to get your money back in 1 year. 10% on 1,000 rupees is 100 rupees, right? So at the end of 1 year, you're going to get your money with which you bought the bond, that's 1,000 bucks, plus the interest, which is 100, 10% of 1,000. That's what you're going to get, right? So it's 1,000 plus 100, 1,100. That's what you're going to get after 1 year. What is bond yield? Bond yield is the interest that you have, this 100 rupees that you're going to get as the interest at whatever rate. It's 100 rupees upon the bond price, which is what is being traded in the market. So if you bought a bond at 1,000 rupees, which is currently being traded at, say, 800 rupees, so it becomes 100 divided by 800, so that becomes 12.5% is the yield. Similarly, basically the relation is that if your bond prices go up, your bond is going to drop, and vice versa. That's how it's related. Interest on government bonds. This is a sign of economic health. If the interest on government bonds keeps rising, it means the economy is in a downward spiral, because interest on government bonds are basically what the government gives to you for borrowing money from you. If the economy is in a bad shape, they are going to give you more interest, right? So it's high risk, high interest scenario that happens, right? There are other concepts such as interest spread and all that, and there's also another fundamental which, like, longer bonds, like 30-year bonds, 10-year bonds, have more interest than shorter bonds, because shorter bonds are not exposed to so much of risk as the longer bonds. So these concepts are also there. So that's it. It's a pretty hurried session because of this time limit, and post your questions on the Google spreadsheet that I'm already put it on PG, right? Thanks, guys.